Webinar will begin in 1 minute. Welcome everyone. We are pleased that you have joined us for today's webinar titled What Every Financial Professional Needs to Know About Trusts, Part 1. The webinar will last approximately 15 minutes, and at the end you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Jennifer Lawler. Jennifer joined the Advanced Underwriting team in October of 2014. Before joining the team, she spent 6 years working for a tax and estate planning group. While there, she worked extensively on tax return preparation, estate planning, and she assisted clients with their tax needs. Jennifer will draw on her legal, life insurance, and practical experience for today's webinar. And here she is. Jennifer?
Thanks, Linus. Hello, everyone. Thanks for joining us today. As Linus said, we'll be talking about trusts. As we all know, trusts can be a very important estate planning tool. While trusts should be established by an attorney, financial planners should have a working knowledge about trusts in order to help best serve their clients. In today's webinar, we will discuss common trust elements, when and how trusts are created, typical trust structures, how trusts are administered, and some common types of trusts and their primary purposes. To familiarize ourselves with the lingo, we will start today with some common trust elements. A trust is a legal entity with a legal status separate and apart from the person who created the trust. A trust is usually established by a written document which describes how the assets within the trust can be used, invested, and distributed. Some states allow for trusts to be created orally, but these usually prove to be problematic and hard to administer. A grantor is usually the person who created the trust and contributes money or assets to the trust. Trusts usually have one grantor, but some married couples may wish to create joint trusts. The trustee is the person or entity charged with making sure the trust rules are followed. The trustee holds legal title to the trust's assets. The trustee must act in a fiduciary capacity for the benefit of the trust beneficiaries. There may be one trustee or more than one co-trustees. Beneficiaries are those that are entitled to receive or request distributions or other benefits from the trust. Current beneficiaries are those who are entitled to ask the trustee for immediate benefits from the trust. Contingent or remainder beneficiaries are those that are entitled to benefits from the trust after the trustee has fully met the trust's obligations to the current beneficiaries. Trust corpus or trust principal are the assets that are titled in the name of the trust. Income is the earnings generated by the corpus based on the trustee's investments within the trust. Most commonly, trusts are created when an individual visits an estate planning attorney. A living trust is one that comes into existence immediately after creation. Living trusts can be revocable or irrevocable. Revocable living trusts are quite common and can be easily changed by the grantor. Irrevocable trusts cannot be changed by the grantor after creation, except in very limited circumstances. Testamentary trusts are created by special language in an individual's will. They do not come into being until after the individual's death. Some of the most common trust provisions include identification of beneficiaries. Now, this is a very important one. Beneficiaries should be easily identifiable by the language in the trust. The trust should also include a description of types of allowable distributions that the trustee can make and when they can be made and to whom. The trust document should also include a statement of the revocable or irrevocable nature of the trust. It should also include specific powers of the trustee and when the trustee must act. Most trusts also include investment philosophy of the trust and any prohibited investments. They should also include trustee resignation and succession rules if a trustee can no longer serve as trustee. Most trusts will also contain a choice of law that governs the trust if a lawsuit or legal claim should arise. The trustee's duty is to follow the rules set forth in the trust document and to administer the trust's assets for the benefit of the trustee's beneficiaries. It seems like a no-brainer, but the trustee must keep the trust assets separate and apart from their own assets. The trustee cannot use trust assets for personal use unless the trust permits otherwise. The trustee may be responsible for investing the assets within a trust in order to conserve and build value. The trustee should keep good records for both accounting purposes and for the benefit of beneficiaries. The trustee has an obligation to provide regular information about the trust, its investments, expenses, and distributions to the trust beneficiaries. The trust may contain reporting requirements that the trustee is obligated to adhere to. Some trusts have mandatory distribution language, while others may provide discretionary authority to the trustee to make distributions. The trust may provide rules on how to decide whether or not a discretionary distribution should be made. Some may provide no guidance at all for discretionary distributions, besides noting that they can be made. If a trust tax return is needed, the trustee must arrange for its completion. One of the most important tasks when creating a trust is picking the best trustee for the trust. Trustees can be responsible family members, a trusted friend, an attorney or CPA, or even an institution such as a bank or a trust company. There are pros and cons to each option. Professional trustees are less likely to get involved in family conflicts or drama. Professional trustees can be easier to deal with than a non-professional trustee when conflicts do arise. Professional trustees may be more objective than non-professional trustees because of their professional capacity, they are more likely to handle tasks in a timely manner. And maybe most importantly, a professional trustee is less likely to be grappling with the grief of losing a loved one. The major disadvantage to using a professional trustee is the cost associated with the management of the trust. Non-professional trustees have their own lists of advantages and disadvantages. Non-professional trustees are less likely to charge a fee to administer the trust, or will do so at a much lower rate. A non-professional trustee may have a better understanding of the family's dynamics and thus be better suited to making hard decisions. A non-professional trustee does run the risk of ruining relationships if they fail to do what the beneficiaries want. And if a non-professional trustee makes a major mistake, they will be less likely to be able to repay the trust. And finally, because a non-professional trustee does not administer trusts every day, they may fall behind in performing important tasks. Now we're going to talk about some common types of trusts and what they do. Testamentary trusts to protect minor children are created by special language in the grantor's will. The trust provides temporary supervision of money intended for the benefit of a minor. But these types of trusts can last long past the age of majority. Revocable living trusts spring into existence immediately upon creation of the trust documents. These types of trusts are commonly used to help the grantor avoid probate. The grantor transfers assets that would normally be subject to the probate process to the trust prior to death for administration after the grantor's death. It is very common for the grantor of a revocable living trust to be the trustee during their lifetime. Married couples may even want to create joint living trusts. Irrevocable life insurance trusts allow the grantor of the trust to exclude assets from their estate. Because of this, the grantor cannot act as trustee. If the grantor has control of the assets, they will not be excluded from the grantor's estate. When ILETs are funded by life insurance, they allow the grantor to provide liquidity for death taxes and final expenses without subjecting the proceeds to estate taxes. But ILETs can be useful for non-tax reasons as well. A grantor may create an ILET when their heirs are not responsible with money, or if they have complicated beneficiary needs. ILETs also have their drawbacks, namely being irrevocable, which makes them hard to almost impossible to change. Dynasty trusts are trusts that are intended to last a long time after the death of the grantor. The special language needed for a dynasty trust can be found in a testamentary trust, a revocable trust, and an irrevocable trust. Asset protection trusts are used by individuals to shield assets from creditors. The effectiveness and rules regarding asset protection trusts vary by state, but they must be irrevocable for the discretionary use of the grantor and for the ultimate benefit of the grantor's family. Special needs trusts are used to protect those with disabilities that qualify for needs-based government programs. The key to qualifying for those programs is that the individual must have a financial need. If the individual were to receive funds outright, they would likely lose their benefits. A properly drafted special needs trust allows the trust to provide limited benefits for the individual without adding to their countable assets. They must be very restrictive and only pay for things the individual's current benefits do not cover. Charitable trusts are tools that allow individuals to give to charities. The most common form of charitable trust is a charitable remainder trust. In a charitable remainder trust, the donor donates assets to the trust and then receives an income stream from the trust for their lifetime or a set number of years. After the donor's death, the remainder left in the trust is given to charity. Charitable trusts are sophisticated, but if you have charitable-minded clients, they can also provide tax benefits for the donor. When the assets are given to the trust and then sold, they do not generate capital gains, which can allow a donor to sell highly appreciated assets without creating capital gains tax. The donor receives an immediate tax deduction equal to the value of the donation minus the present value of the income stream. After the donor's death, her estate receives an estate tax deduction for the value of the charitable remainder interest that goes to the charity. Hopefully today's discussion has been an informative one. We talked about some of the fundamentals of a trust and the importance of picking a good trustee and what that trustee's responsibilities are, as well as some common types of trusts and their common uses. But we've only scratched the surface. Join us next month for part 2 of what every financial planner needs to know about trusts, when we'll discuss trust taxation, common myths and misconceptions associated with trusts, and the role of life insurance and annuities in trust planning. Thanks for joining us today.
Thanks, Jennifer, and thanks again to all of you for joining us today. As a reminder, if you would like to receive supporting materials related to today's webinar, feel welcome to email us at asktheexpert@advancedunderwriting.com. That's asktheexpert, all one word, @advancedunderwriting.com. You may also email questions related to today's webinar. As Jennifer mentioned, feel welcome to join us for part 2 of this webinar on Wednesday, April 5th at the same time as today's webinar. You can also find an archive of our webinars on our YouTube channel. Finally, for more information about the services that Advanced Underwriting Consultants offers, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.